Basically, what you'll see now are the annual revenues of two actual design firms, Company A and Company B. Obviously, we're not revealing any names today. And at first glance, my guess would be if I were to ask all of you to choose which firm you would rather have as your own between these two companies, most of you, and I'm sure all of you, would choose Company A that has 1.5 million a year in revenue versus Company B, which has approximately 800,000 in revenue. But let's take a deeper look into the financials of these two companies. And what you will see is that actually Company A makes less money. If you look all the way to the bottom at the net income number, you'll see that Company A makes a lot less profit than Company B to the right. You'll see Company A made $120,603. Company B made $202,877. So that begs the question, how could that be? How could a firm that generated so much more revenue and clearly worked much harder, how could they make so much less money? And what I'd like you to kind of focus down here is this gross margin percentage here. You'll see that Company A had a gross margin percentage of 25%, and Company B had a gross margin of 40%. So you'll see that, so what I was saying is that Company B made a larger bottom line profit than Company A, despite the fact that they generated a lot less revenue for the year. And the main reason is that Company B's gross margin percentage is 40%, Company A 25%. And this, I believe, is the largest problem for designers in the industry that I've seen since getting involved with the design business 15 years ago. Managing that gross margin percentage it's just about everything. I don't want to say everything because obviously you have to keep an eye on overhead, and I don't want to understate the importance of keeping an eye on your overhead. But when we take on a new client, we typically see our clients in the 25% range. And as I will explain throughout the presentation, we'd like all of our clients to be closer to the 40% range. And so I'd like to spend some time talking about what is a gross margin percentage and how can you get to that 40% number that I've seen to be an industry standard and is more of a kind of a market rate for where designers should be. So a gross margin, the definition is simply your gross revenue less your cost of goods sold. Another way to put that is it's your job profit before overhead. And cost of goods sold, so revenue would be all the money that you would bill your clients for your hourly billings, for any markup on the cost of goods sold, and it would also include the cost of goods sold. And cost of goods sold could be either product or labor. That does not include payroll, That does not include payroll. Payroll, we typically put down in the overhead expenses. Now, you could make an accounting argument to put some of your payroll in cost of goods sold as part of the direct cost of services. However, we found to do an apples-apples comparison with other firms that it's easier for us to benchmark when we move that payroll number down into operating expenses. Okay. So when I talk about gross margin percentage, we arrive at that number by taking the total gross margin dollars divided by the gross revenue dollars. And I'll give some examples how we do that moving forward. One common area of confusion is that it is confusing markup percentage with gross margin percentage. A A markup percentage is taking the profit on a job or the profit on a product and dividing that by the cost of goods sold. Where gross margin is taking those profit dollars and dividing them by the gross revenue, which is always a higher number. So therefore, your gross margin percentage is always going to be lower than a markup percentage. So it's a little bit of a confusing term, but just remember that when I talk about gross margin percentage, I'm not referring to a markup percentage. So just to demonstrate the power of a gross margin, what I have here is 4 separate firms here, 4 profit and losses, and this is not real data. This is hypothetical data for 4 firms that all do $500,000 in annual revenue, which you'll see across the top. They all have the same revenue. And if you look down towards the bottom, you'll see that they all have the same amount of overhead or operating expenses, okay? So the only difference in all of these 4 firms is the gross margin percentage. And you'll see that the first firm achieves a gross margin percent of 40%. The second firm achieves a gross margin percentage of 30%. The third 25%, and the fourth 20%. Now, if we scroll all the way to the bottom, let's take a look at what the impact on the bottom line profitability is of the designer losing, gross margin percentage. So the first designer is going to make $120,000 net profit with a 40% gross margin percentage. The firm with 30% goes down to $70,000, so that's $50,000 less just from going to a 40% gross margin percentage to 30. And you'll see that the profit will continue to go down to 45 at 25% gross margin and 20 with a 20% profit margin. It's unbelievable. It's exactly, and I think you'll find that the numbers aren't always intuitive, right? You wouldn't think, without looking at these numbers, that there would be that big of a difference. And just to kind of put in perspective what these gross margin percentages equal, if you were to charge 25% markup on all your product and no design time on top of that, just a 25% markup is equal to a 20% gross margin percentage. So if any of you out there are charging a 25% markup and no or little other fees, on $500,000, you could expect to make $20,000 of profit. And you'll see that that just is not acceptable for the work that you're putting in a $500,000 business. And to further illustrate this point, a 35% markup, if you were to translate that into a gross margin percentage, that's equal to a 26% gross margin percentage. So yes, so it's I know. Well, but again, so I'm talking 35% markup, right? 35%, right? So if you convert a 35% markup into a gross margin percentage, so let me give you an example. If you were to buy something for, let's just say $1,000, and you were to mark that item up 35%, your profit would be $350. If you take the $350 divided by the total sales price of $1,350, that equals 26%. So for those of you who do a 35% markup and no time or little time, you'll see that you would fall close to this 25% column, which you would make only $45,000. And you'll see that I don't believe that that's a reasonable number for a designer to make on a $500,000 of revenue. And that's what, it's exactly why, exactly. That's exactly it. And you'll see even at 30%, 70 is getting in the ballpark, but it's still, still not reasonably. And I think you'll see from these numbers, and no matter how you run the numbers on designers' financials, you really need to be around 40% to make a bottom line number that is reasonable. Again, we're just talking reasonable, annual income given the value that you're providing your clients.